Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, August the 14th, 2024. I hope you like the new microphone. Spent big bucks on it, and the sound quality should be really good. According to my son, this is one of the best microphones you can get your hands on, so it better be the case. So what are we seeing here? Three different doors, three different colors, because we don't know yet which door the market will take. What we do know is that we most likely had three waves lower on the S&P 500, on the Dow Jones, and potentially also on the NASDAQ 100, but potentially not on the semiconductors. I always say potentially because we are wrong till proven right on the markets. It is an interpretation method, the Elliott wave, and we don't always get it correct. But for now, as we've said before, after three waves lower, expect always at least three waves back up, because either the correction is over, it's just three waves, and we're going to start a new impulse, nothing new, that's what we already were looking for, or we're going to get a protracted, longer, more complex correction, three down, three up, another three down in a triangle, for example, or three down, three up, five down for a larger wave four as a flat. We just don't know yet which one it will be. That's the unfortunate nature of the markets, but also that we already had on our map. So now we are at least in a counter trend rally, which could be sold off later in September, October. Wouldn't surprise me if that is the case. Maybe the Federal Reserve will not lower interest rates because inflation is still, in their eyes, too high, and they might instead destroy the jobs market. To be determined, that is kind of like tinfoil wishful thinking. What matters is price, and price only, because price pays, and price is the final arbiter. Price is the aggregate of everybody's opinion at a certain moment in time for the market, be it at 12 midday, be it at the end of the day. This is where the consensus is on where the market should be, like it or not, and that is the only thing we trade. So let's go to the charts and see what we have and which door we are currently standing at. This is the chart of the Dow Jones. Let's start with this one. This was option one, door one, that we would see an impulse lower. And of course, the impulse cannot overlap with the wave one low. Only diagonals can do that. Well, diagonals are quite unreliable. So for now, this wave count is off the table. Of course, it's fully confirmed that it's off the table back above the wave two high, which is at 41,207. But for now, this is the least likely option. And we move to the other option we have, that we are now already in this red wave 5 of black wave 5. I'll show you that in a minute. I hope you won't hear my cat in the background, which of course starts to meow when you get a new microphone. Well, so be it. So we have now had two pullbacks so far, and I must say that that is quite inconclusive on where exactly we are in the shorter term. But these are the warning levels we've had for the bears on the map. The blue one is the first one, the gray one is the second, the orange one is the most serious one, and then of course the red one means it's all over for you bears. We're going to go to new highs, be it either as a irregular B wave or as a impulse, to be determined. And as you can see, we're knocking right here at this third warning level. We've had this on the map all the time. And let me add that to the chart as well, so you understand where we are from a bearish perspective. So the bears are now really being pushed to the max on, if you are short, you might want to consider stop shorting. Now, honestly, I think shorting the market in general is not a lucrative business, because long-term the market is, of course, bullish. What's the point of having a stock market that only goes down? The stock market long-term trends higher. But hey, whatever floats your boat, excuse me, we are, of course, now back above the 20, back above the 10, the 50, 200 days. So this is soon a full-on 100% bullish chart, if also the moving averages start to point back higher. They're still pointing lower, especially the 10 and the 20. But we're above the Ichimoku cloud. So far, so good. This is, I would say, an 80% bullish chart, and trade it accordingly. This was option one we were tracking, or door one for the NASDAQ 100. I showed that also for the regular NASDAQ yesterday, that we would see a 3, a 4, and a 5. And as you could see early in the week, potentially even late last week, it was still possible to see this 4-5 setup. Not anymore, because we have now overlapped with this potential wave one. That's not allowed, as I just explained, for the Dow Jones. So this is not confirmed. We can delete this chart from our database forever. We'll do the same here for the Dow Jones. There you go. I won't use it anymore until I see a diagonal. But diagonals, once again, are unreliable and not very likely. So the most likely option is that we have completed only 3 waves lower. I'm sorry, bears, that's just the way it is. We can still have, by the way, completed a much larger top. And this is simply wave A of a larger correction that's going to move in threes. For example, 3 down, 3 up, and then another 3 down, potentially 5 down for a larger A wave. This has happened for Tesla, for example. I believe it was last year or the year before, where the A wave in itself was a irregular flat. So we had a large A wave, a large B wave, and a large C wave for Tesla. I'm not going to pull up the chart. Maybe I should, but that is from my memories. And the A wave itself was a flat. So that is always possible. Okay. Just because we get 3 waves lower doesn't mean this larger top is in. And again, after 3 waves lower, always expect at least 3 waves back up. The B2 pullback, that was a quite easy one. And since then, shorter term things have been more muddled, because the rally since that B2 low is a little overlapping. But again, we're right here in this ideal C/3 target zone, because we don't know if we could potentially get a new impulse higher. But for now, we're focusing on the A, the B, and the C. Why? Because that is a conservative method to be aware that we can still, of course, drop once again. And beggars can be choosers and pigs get slaughtered, all that good stuff. But what we see here is, of course, that we are still below, in this case, the 50-day simple moving average. We're just back above the 20-day moving average. And that one is, once again, not pointing higher, but it is also pointing lower. We're back above the 10, and we've remained above the 20-day moving average. So this is C/3 underway, and this is the ideal target zone. And as you can see, we're bumping right our head once again at the 3rd warning level for the bears. Let me put that on the chart here as well. Warning levels for the bears. And as you know, for my premium members, those that will listen now won't know, but that is what you get after the fact, is that we have continuously looked higher. Yes, we would have liked to see a pullback. Remember, that's what we were looking for 2-3 days ago, and all we got was maybe a tiny little intraday pullback, as I shared yesterday with you. And it's possible. Again, I don't make the markets. If normally a market retraces anywhere between 38.2 and 76.4%, you just don't know where it's going to bottom until you have more price data available. Sometimes all we get is a 23.6% retrace or a 14% retrace. Okay, it doesn't have to be 50 to 62%. We cannot predict the future. We can only go by what is standard. And oftentimes the market won't give us those standard either retraces or extensions. So please remember that the short term is therefore more variable, but the intermediate term, this was the path we were looking for, has filled in quite nicely. Nothing out of the ordinary. We'll just, brush these intraday anomalies. It's not even an anomaly, but intraday differences from what we expected aside. We continue to look higher on the intermediate term. And short term is, of course, hours, maybe days. Intermediate term is days to weeks. So far, so good. I don't think we have topped just yet for this C/3 wave. I have 0 signs that is the case. Okay, there are 0 signs that we have topped already. Just like yesterday, 0 signs that we would have put in a large top. There could have, but I had 0 signs on no chart whatsoever anywhere. So always bear with me in that sense that I do not have a crystal ball that can predict everything. And if we have no signs that there is a top in place, most likely we won't have a top. It could always happen. So that's why we have our warning levels, as I shared with you yesterday. Semiconductors, this still looks reasonably well as 5 waves lower. 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 5. And note we have now rallied substantially. I must say, I actually deleted the screenshots, but I have been a buyer last week. So not that it helped you much, but I am still long. I have trimmed a little bit going into the CPI data, but it looks like inflation is not an issue anymore if you're not so desired to think about those issues. But I think jobs is now going to be more important. As I said, is the Federal Reserve going to keep its interest rates high and potentially destroy the jobs market in a focus on inflation? Or is it smart enough to realize we must take care of people's employment as well? But of course, higher employment can increase inflation again. So that's their job, not mine. I just interpret the data. And as long as we move higher, we move higher. But again, this still looks corrective. And again, for semiconductors, it looks like we haven't really reached, I would say, the minimum upside target of around 5,100 to 5,250. So I expect still higher prices. Again, of course, contingent on holding above key levels. That is, first and foremost, today's low, then yesterday's low, etc. Okay. This is the bigger picture I shared with you in our previous webcast of the impulse we're tracking. This is the 1, this is the 2, the 1, the 2, the 3, the 4, the 5. All based, of course, on the correct interpretation of this price action. It's not the easiest, but it looks pretty good. I must admit, as you can see here, the wave 3 almost got to 161.8, 4 at about 100%, 5 here at 200%, measured, of course, for this length of wave 1. Wave 2 here, 62%. This wave 2 here was about 50%. It's a little bit ugly, I must admit. This wave 1 is bigger and longer in time than this wave 1, but it's not necessarily a must rule that the 1 degree lower wave 1 is shorter and abbreviated in time compared to the 1 degree higher wave 1. It doesn't have to be that way, okay? It is normal, of course, to expect that. Then we had an irregular flat wave 2. And now we're looking here for this wave 4, which can have already completed as a simple zigzag. Okay, so that is then our first option. Let's see where we are here, that we are now in this impulse higher for a wave 1 of 5, 1, 2, 3, 4, 5. I have so far 0 indication that this is not the case. Okay, so the warning levels for the bulls we can now raise. Okay, so the first warning level is, of course, today's low. The second warning is then, of course, yesterday's low, which is pretty close to Monday's high. And then the third warning level can be raised to, I would say, this wave, potential wave 2 low. Why is it potential? Because we still don't have confirmation of 5 waves up. And then the ultimate warning level remains, of course, at last Monday's low. Very simple. Now, the MACD has given a buy signal, all good, all nice and dandy. So we're going to track if we can get 4 waves up. Okay. So those are the warning levels we're going to look for. The other option is that we have an ABC underway. Again, the warning levels for the bulls, even for this path, can of course be raised, which is really nice. However, I do want to point out that the 161.8 extension of a potential wave A, which we have, of course, at this Wednesday high, I believe it was. And then, of course, the Wednesday low was then wave B. The 161.8% extension targets exactly the 76.4% retrace of this decline. So that looks like a very logical target. And I outlined that as well in, of course, yesterday's update. So again, the first warning for the bulls is, of course, today's low. Why? Because then we're going to make a lower low if we go below it. And lower lows are a first sign of a trend change. Can be short term, but again, that's what we're looking for. And I'll show you here the 161.8% extension. So here is wave A right there. This is wave B, and we're going to measure it there, as you can see, very nicely. Gets it very nicely. Let me make sure I get it all precise. That's pretty good. So that is what we're going to look for. That looks like nice confluence right there. And from there, we can do, of course, our C wave lower. And I'm going to give you an example. Going here to, I believe, January 2016 low, which all started all the way back in the summer of 2015. You had our initiation move lower, wave A. Look at these candles. That was some scary times, my friends. We went from 2000 all the way down to 1800. That was an easy 15% correction in a matter of days. Rallied all the way back again to over 2000 and then declined again. So this is then wave A, this is wave B, and this is wave C. Okay. So this is a large flat. In this case, expanded flat because wave C ended below the end of wave A. So we could easily be in here. And as you can see here, the counter trend rally lasted several months. So we can easily get that here as well. Now here, the initial decline was, I would say, only a few weeks, whereas here it was a few months. So also the counter trend rally should just be a few weeks. And again, it looks like 55.40 plus or minus 10 is a decent upside target. And then we could move lower. But again, we only know we're going to move lower if we start breaking below these warning levels. Okay, so that's what we're going to check for. We have no confirmation of those just yet. So that's the ABC versus the 1, 2, 3, 4, 5. And again, if we get a 4, 5, we need to hold above those warning levels, right? Very simple. If we don't, then it's most likely going to move to the other option. Now, here is a chart that the bears probably don't want to see. And that is that the AD line made new all-time highs recently, late, excuse me, July, and also here mid-July. It confirmed the mid-July top. And as you can see, we're almost back to new all-time highs. That is not bearish, okay? The AD line, which is kind of like a measure for liquidity, it just tells you how many issues or stocks, but there's different things in there, bonds, I believe, as well, are rising. Okay. And that's a good sign because everything requires a buyer for it to rise. That means you need to have money for it. So this is good. This is not a bearish sign. Okay. You want to see lower highs and lower lows here as well to turn really bearish. So this one is keeping me on the, no, I don't think we've topped just yet side, which again sides us with a wave 3 and a potential protracted wave 4. Alternatively, all of wave 4 is complete. Let's look at the McClellan oscillator. It's at 23. It's not like a wow kickoff wave, but it is positive. Okay, we bottomed here in May on Monday in the, I would say, first buy zone. Okay, so we're positive. What does that do to the summation index? The summation index has now switched to a buy signal. Okay, it went from a brief sell signal, as you can see, to a buy signal. Why? Because the summation index is now back above its exponential moving average. It's a 30-day moving average. Might be arbitrary, but it is now a buy signal. So that's also in favor of the bulls. Just like the AD line is in favor of the bulls. How we're doing on the PMO buy all, sell all, it is still bottoming out in the ideal bottom zone. It is at 0, and oftentimes this is from where we get pretty good, strong signals. Not all the time, can't predict the future, but also here we had a buy signal. Let's go back here in May. That was a good buy signal. Here in January, that was a good buy signal. The actual PMO didn't do well, but the market did do well. We had one here in November, good buy signal. We had one here in October, not a good buy signal. Okay. We had one here in September, not a good buy signal. We had one here in September again, not a good buy signal. But here in May, it was a very good buy signal. Here in March, very good buy signal. Here in January, reasonable buy signal, etc. So you can see most of the time we get a pretty good buy signal out of it, but nothing works all the time in the market. It's not 100% guarantee. That's why we need to track the markets. What I do like is that the indicator, the KST, which is a smoothed indicator of the trend for the buy all, sell all indicator, is really bottoming out, quite oversold. So we can get strong rallies from this one out of it. So that looks really good. Last but not least, Seasonality suggests that we would have a bottom here somewhere in early August, which we got. I believe it was August 4. Let's see when it was. That was last Monday, August 5. Let's see here. What did we get? August 4, 5. That's pretty good. And we should now kind of choppy chop rally into late August, early September. And from there, on average, see a decline. So that could fit with our A and then the C, or sorry, the B, and now the C wave eventually. We're not going to hang our hat on it. We're going to track it. So for now, it is reasonably okay. And this suggests higher prices going forward. So this B wave can easily continue, or it's going to be an impulse to complete a much larger wave. Okay, so this suggests higher prices, but again, breakdowns below any of these key levels that we showed you for the bulls will tell us, no, this path is not going to get followed. So this is just a nice, okay, let's keep this at the back of our minds, but not hang our heads on it. So this is where we really are currently. So things have improved. The AD line has improved. That's a fact. They cannot dispute it. We have a buy signal. Again, doesn't mean it's all good times ahead, but we have a buy signal on the summation index because the McClellan oscillator is positive. Now let's see how this is going to progress over time. Again, we have our warning levels on the charts. I can do, of course, the same for the other indexes, which I might actually do just so you know what to look for. I'll do the same wave count, update it for you, and send it to you. And that's where we are at for the moment. I have a very nice roadmap on our charts that has been filled in reasonably well. We did not know yet a couple of days ago to a week ago if we get 5 lower or not. It surely doesn't look that way. So now we're going to look here for completion of this bounce, potential new impulse. We'll know soon enough, but I prefer to look higher for as long as at least today's low and at least yesterday's low holds. Take care, trade safe, and I'll catch you all later this week.